All right, and we are live. Hello, everyone. Welcome back to another episode of Trade Risk Live. Thanks for joining us. Today, I'm joined by my good friend, Felix Bertram. Felix, how are you?
I'm very well. How are you doing today?
I'm doing great. I'm doing great. And for those of you who, Felix may not be super familiar, but the name might sound familiar, we've done a couple of things together. We did a podcast about a year ago. I believe it was episode 2. And I will link all of that up if you want to learn more about Felix, about his work, about his website. We're going to talk a lot about that today. But Felix is an electrical engineer by background. He's got a master's degree in that. He also holds an MBA, and he loves markets and he loves building trading systems. And I am super excited for the presentation he has put together. I got a small glimpse of it, but I am excited to see him kind of talk through this. And for folks that are listening, feel free to leave a question, drop a comment as we move along here. If you've got anything that's on your mind for Felix or myself, I'd be happy to take it as we move through this presentation. But I think that's pretty much everything. We had an interesting start to the day today, Felix. You see those opening prints? We're going to have a lot of data to clean up on on some of these market prints. Did you catch that on some of the halted stocks this morning?
Yes, I saw that. I have some of those in my portfolio. I was wondering, hey, what's going on?
Right. Yeah, I looked at my P&L real quick and I was like, wait, what? How did I jump that much in overnight? But anywho, okay, I'm gonna put your deck up now, and I'm gonna let you kick things off here. And as a reminder, folks, leave a question as we move through this or comment. You can find Felix at turingtrader.com, and we're going to talk a lot more about that. So Felix, take it away.
All right, great. So hello, everybody. Today we want to talk about Monte Carlo simulations. And more specifically, we want to talk about how we can visualize the relationship between the investment period and portfolio volatility. Before we do that, a quick disclaimer. So this is for informational purposes only. This is not financial advice, and past performance is not indicative of future results. So here's what I want to talk about today. So first, I want to describe the problem that we're trying to solve, and then I want to talk a little bit about the method. I want to present some examples, how we can use this method, how this works. And then I want to show the practical application of all this. So let's talk about the problem first. So we all know that investing is about a balance between returns and volatility. And intuitively, we have a good idea that in the short term, volatility drowns the trend. And this is quite easy to see when you think about markets going up in a year, maybe 15% or something like that, and you distribute that evenly over all the days, then from that move, you only have very little for a single day. And that is much less than the day-to-day volatility, the day-to-day up and downs of the stock market. So the shorter your period gets, the lower volatility your investments should have, because otherwise you're no longer really doing something that is defined by trends or something that you might be able to predict or forecast in any way, but much more of the daily, more or less random ups and downs. And there's products out there, and they've been out there for decades. For example, these so-called target date funds. And the idea here is that you change the asset allocation over time. So you're starting when you're young and you're holding a 60-40, and then there's a transition period where you're reducing your exposure to stock markets and increasing exposure to fixed income products. And then in late retirement, you're holding a very conservative 20-80. So far, so good. And as I said before, these products have been around for ages. But how can we actually quantify this? Is this actually the right thing to do? How should we reduce volatility? And can we compare the effects of different approaches here? And is there a science to this, or do we just have to guess and hope? How does this all work? And I looked around if I could find any prior art on this, and I found that pretty much every financial planning package includes some Monte Carlo simulation. And most trading platforms include something there. But these tools are really not geared towards asset selection or strategy selection, especially the outcome is not described in a way where it's relating to the investment period. For financial planning, at least you can see what's going to happen, but you see that basically on the analysis side, and you have no guidance when you're selecting before. So therefore, this justifies looking at novel approaches and finding a different way to do this. Okay, so let's have a look at this method. And the method that I've chosen here is Monte Carlo simulations. And these methods are called Monte Carlo because at the core, it's basically random experiments, like in a casino, more or less. And we conduct a large number of these random experiments. And then we create a quantified result by looking at the outcome of all these experiments. And the reason why this is so cool is because we can use this method to create numerical results when we have no idea what the closed form solution or formula might be, or if there even is such a formula to calculate this.
So I'm going to jump in here and I don't want to disrupt too much or get too into the weeds, and you might be talking about this soon, but as you mentioned, there are lots of different charting platforms or backtesting engines or simulation engines that have Monte Carlo simulations built into their application. But I've seen all kinds of different actual implementations of Monte Carlo conducted. So like I've seen, for instance, some platforms that will just randomize your trades. That'll look at your back history, your back test, your simulation, and then they'll just randomize your trades. I've seen some that will actually manipulate open, high, low, close data and like give your system rules a new set of sort of kind of training data or some different things. Does that make a difference? Like, is there a distinction here? Is there one that's better than the other? Or are we just trying to get a large probabilistic like cone of outcomes here in one of these?
The problem is, how do you create this cone of outcomes? And randomizing the trades might not actually be the best way to go, because honestly, we're interested in what we're holding, and we're not necessarily interested in changing the sequence of the trades. Right. And also, what I'm really looking for is this relationship between investment period and range of outcomes. And that is something that is very difficult to grasp in any implementation that I've seen so far.
Got it.
Does that answer the question?
Yeah, I think so. I mean,
then maybe you interrupt me again when we see the charts, how I'm looking at this. And
let's do that.
That might make it a little more clear.
Okay.
All right, cool. So how does this work? And here's a very simple example. So let's estimate pi. And this is something that is actually really easy to do. So basically, we start creating random coordinates, all in this little box. And for every coordinate pair that we're creating, we can easily evaluate whether it's inside or outside of the circle. So all that requires is the Pythagorean theorem, and you can basically figure out whether it's inside or outside. And now we can tally up the hits inside and outside, and then we can estimate pi just like this. And what's so cool about this really is we don't need to have any idea about trigonometry or anything like that, or any sophisticated formula. All we have to do is tally up the results. And we can do similar stuff when looking at stock markets. And so here's the S&P 500. And what I've done here is, first I've analyzed the asset returns, specifically the mean and the standard deviation. And now I've created a swarm of equity curves. And none of these have ever happened in the past, and probably none of them will happen in the future, but they may. These are all hypothetical outcomes, and all of them are matching the statistical properties of the S&P 500. And now we have this swarm of possible outcomes. That in itself is not particularly useful yet, but we can clean this up and make it look like this. If basically we rank the equity curve at each point in time and pick values at certain percentiles. And for this cone that I've created here, I've chosen the 5th and the 95th percentile. And what that does is it gives us a range of outcomes with known confidence. So we know that with a probability of 5%, we're going to have something that's worse than this cone. So it's going to rank below this cone. We are going to have a probability of 5% that the results might be better. And we have the confidence that with 90% probability, we're going to be right inside this cone. And when we look at this cone on the left, it's a little hard to see, but you can see where the orange and the blue meet, that actually the orange first goes down. So this is the first indication of what I said in the beginning, that volatility drowns the trend. When you look at the 5% of the worst outcomes, then in the beginning, well, first you're going to see negative returns. This is still not particularly useful because now we're still dealing in terms of equity over time. What we really want is returns. And so we can create this by basically dividing this by time. And now we get this. Now we can see that the white side is on the left. So now we know what the expected annualized return is going to be over time. And the same confidence intervals apply. And this is actually something that I've not seen done before and that I wish that other platforms would actually do, because it's actually surprisingly useful. So let's have a look at how we can read these charts. So here at the very left, horizontally, that is 1 year. So we can now say with 90% confidence that the S&P 500 is going to have returned better than minus 0.18.6% after 1 year. Or actually, the probability that we're going to lose more than close to 19% in a year is about 5%. That's about 1 in 20 years. We can also say that with a confidence of 95%, returns of the S&P 500 will be positive after 9.6 years. And we can say that over a period of 25 years, we are 95% confident that it's going to yield more than 3.2%, but also less than 14.8%. So we now have probabilities and we have clearly quantified returns that in a relationship with time. And this is something that is incredibly useful in trying to figure out what to invest in.
So I do want to just, if you flip back to that one there, just for the audience listening, because so I love this. I'm like half terrified when I see this chart, because I'm like, oh my goodness, when you really look at the potential distribution of outcomes here, and you see something like that after 10 years, you can be confident that you would have a positive result holding the S&P 500 with a 95% confidence ratio. That's a little scary, right? But it also explains why we do what we do in terms of managing risk and trying to, I'll say smooth out returns, but that is it. And when you look at this cone of distribution here, I think it just shows you just how much noise, variability, volatility there really is in a single strategy, a single asset class, et cetera, et cetera. So yeah, I think that's super cool. I love this view and I haven't seen it before. So nice.
Yeah, well, it is something novel. I honestly thought about it quite a long time, how to do this. And you will see it in the last part of the presentation in the application, why I actually worked on this, what motivated this, what I really wanted to do. So now the first question is, do you want to be an optimist or pessimist, and why is that? And the first thing to really think about is, why are we investing? What are we trying to achieve? And when you're investing for retirement, the important takeaway is you're not interested in the average outcome. You're interested in the in maximizing the reliable outcome. So therefore, you want to look at the pessimistic assumptions. It doesn't matter that on average, the S&P 500 might return 9% a year. Because you only have one go at this, and when you want to retire, it's really not something that is going to make you happy to say, well, but it could have been better. All that counts is how much can you actually really bank on. And that is fundamentally different from investing for legacy, where you're really trying to maximize the average outcome. So the approach to investing is very, very different when you need to hit a specific goal or when you're just trying to maximize the average. And the portfolios that you're going to invest in will be very different. And most of the metrics that are shown for strategies or for assets are completely meaningless when you want to think about retirement. And then there's, of course, a third section. When you want to invest for social media, then you maximize the hype and you're looking at the most optimistic estimates. And
There
you
we go.
can do this with these charts as well.
Yeah, I love it.
You can create a statement and say, hey, this strategy can yield you up to 30% in just 2 years. So that would be looking at the upper end of it.
Yeah.
Now, the question is, how pessimistic do we want to be? And the first important thing to point out here, the fifth percentile is by far not worst case. So we cannot really optimize for the worst case. And we're going to look why that is a little later. First, we know how we created these charts, and therefore we know a 20th of these experiments had worse outcomes. This is how we created these curves. This is how we consolidated this swarm of squiggly lines into this cone. And now the question is, should we go more pessimistic? Is 5% pessimistic enough? And what I found is that when you go even more pessimistic, then you basically can't invest. So in order to invest, you need to have somehow a positive attitude to things. And here's an example. So when you go from the fifth to the first percentile, your break even moves from 10 years to about 20 years. And when you think about it, investing in the S&P 500 with all that volatility for a confidence of 99% to be break even after 20 years, then there's absolutely no reason to do that. Then the only plausible decision would be to invest in treasury bills. So if we believe that there's still something to be gained by investing in the stock market, then you need to limit the level of pessimism that you apply. And I found that 95% confidence seems to be a pretty good compromise here. You want to say something, Evan?
No. I think you hit it on the head. I mean, if you go any more than that, it would just be so, you would almost never get your money in terms of risk assets, right? When you start to
how will you ever pull the trigger when you say like, oh yeah, you might be positive after 20 years?
Yep.
Good. So now let's have a look at a few examples of what we can do with this. So the first is the S&P 500 versus the 60/40 portfolio. And the question is, should I invest my 401k in the stock market or a balanced portfolio? And well, this is a question that is really not easy to answer when you look at these charts, right? So you see here the equity curve since January 2007, and you can see that the 60/40 has a little less drawdown, but also less gains. And in the end, the S&P 500 leads. So what should I do? And when we draw these charts, it becomes very obvious. And the answer is, when investing for retirement, the 60/40 leads to a higher probability of success. And how do we know that? And we know this here by looking at the bottom of this cone. And so what's shaded blue here, that's the 60/40, and the lines outside the gray one and the yellow one, that's the S&P 500. And you can see that even after 25 years, at the fifth percentile, the 60/40 leads over the S&P 500. So there's absolutely no question that when you want to optimize the pessimistic outcome, the 60/40 is going to be ahead. And this also, by the way, provides an alternate definition of what beating the market actually means. So beating the market at the average is a very different beast than beating the market at the fifth percentile. And now let's look at Bitcoin, just because it's a little more extreme example. So when I add a little Bitcoin to my portfolio, will that help me reach my goals faster than just sticking it all in stocks? And when we look at these charts, you can see the answer is an immediate no if your investment horizon is shorter than 9 years. So thanks to this huge volatility of Bitcoin, you can see that basically the Bitcoin versus the S&P 500 are wash only after 9 years. So everything else is luck. And The other part that's actually interesting is, of course, well, you can still see this huge volatility. So basically, you see this very shallow cone between the yellow line and the gray line. That's the S&P 500. And then this massive width of Bitcoin, well, that's basically 5x the volatility. And this is how this looks like in the range of outcomes. And then this part is actually interesting. So after 25 years, at the fifth percentile, you can expect maybe 22% from Bitcoin. So that's of course a far cry from 120% or something on the more optimistic side of things. And one of the things that I have to note here, these results are largely dependent on which sample period you use for the average and the standard deviation. And for this chart, I used the prices since January 2017. So they look a little better when you go further back in time, and they look much worse when you choose just the last 3 years or so. And we're going to circle back to that later. So now let's have a look at another example, the golden cross versus the S&P 500. So does this add any value? Is it worth trading the strategy? And we know it's a terrible strategy, right? It's prone to whipsaws and it's continuously trailing the S&P 500. But when you look at this, then you'll find it's actually doing something that's quite meaningful. So we're reducing the downside. We're improving the returns at the fifth percentile without removing too much on the upside. So when investing for retirement, this actually leads to a higher probability of success. And we can see that again here, that this gap here is actually pretty wide and pretty clear. And the gap at the bottom is actually almost as wide as the gap at the top. So it's really not skimming that much off the top. The strategy is not as terrible as the equity chart makes you believe. And now let's have a look at a high quality strategy and what the versus the 60-40, what would the result be here? And mainly the question is it possible to increase returns without taking on more risk? And again, these charts tell you a very clear story. And the answer is yes, you can improve pretty much all benchmarks, all metrics versus the benchmark. And we can see that here. We've got a faster break even. We've got higher pessimistic returns. So both combined will actually tell you that this is significantly less risk. But we also have significantly more upside. And so this is basically telling you that risk and returns are maybe related somehow, but it's not a clear proportional relationship. Good, so these are just a few examples that show what you can do. But there's one more that I really want to show you that is really close to my heart, which is also part of why we're doing this. And the question that often comes up is, should I de-risk my portfolio after severe drawdown? So I lost a lot and now found, oh, I'm not feeling well with this portfolio anymore. I'm going to invest in something that's less risk. Is that a good idea? And these charts can help us answer that as well. And first, just as a spoiler, no, you should never de-risk unless you're sure that your strategy has stopped working. And here's why. Before, so this is the same chart that we've seen before with the S&P 500 versus the 60-40. Before, you can see that the riskier strategies, so the S&P 500's outcomes, engulfed the safer strategies. And and now when we're de-risking, we're probably right here. So we experienced a severe drawdown and now decide, oh, this is too much, I can't bear it. So let's choose something that's less risk. So now we switch to the 60-40 right here. Now what that means is we're moving that cone down. And now the important part here is we're hurting everything. So we now have worse pessimistic outcome. We have a worse optimistic outcome. Everything is much worse than it would have been had we invested in the safer strategy right away. So it is important to really understand how risky the strategy is and then staying the course. But pulling the plug after you had a drawdown, that is a terrible idea. And these charts make that very clear. So this brings us to a brief summary here. So it's important to choose the right portfolio. It's important to understand the pessimistic outcome. we should absolutely avoid second-guessing strategies and especially avoid de-risking. And now that brings us to the application of why we actually want to do this. And the problem that we have is, how do we select portfolios? And so, did I just skip one here? No, that's the way it is. Okay, and so we create this chart here and we calculate a range of possible outcomes for a number of portfolios. And now we focus here on this lower left corner. So now here I have 5 strategies. There's a managed bond strategy, there's a low volatility strategy, there's a balanced strategy, an aggressive one, and a leveraged one. And now the question is, which strategy should I invest in and why? So let's have and we can have a quick example here. So let's have a look at a hypothetical investment over 2 years. So that's inside this box. And now we can basically pick the portfolio with the highest return. And that immediately tells us, yes, we should invest in the balanced portfolio because that over that period of time gives us a better outcome than the more aggressive ones, and also a better outcome than the more docile ones. And there's one thing to keep in mind, though. It's still important that this portfolio matches our beliefs and lifestyles. So if this is a portfolio where we don't believe in the mechanics, for example, a portfolio that involves in the phase of the moon and we are not into that, or it trades twice a day and we can't do that, well, then still we shouldn't do that, even though the mathematical correct answer is to choose this one. And it's also important to still match the personal risk tolerance, because if we're prone to second guessing or pulling out later on, then we should choose something that is safer than that. Good. And now, why are we really doing this? And this screenshot is basically a table from touringtrader.com. And the problem is we're tracking more than 40 portfolios on the site. And members have difficulties finding a good match for what they want to do. And well, when you look at this table, and even if you had charged for all of that, this is very confusing and it's really hard to figure out what to invest in. So there needs to be a different way. And what we've done here is we've built a wizard to simplify this process. And this wizard basically goes through a number of questions. How much money are you investing? How long do you want to hold this investment? What's your personal risk tolerance? And what's your tax status? And then boils this list down to portfolios ranked by the relevant outcomes over that time frame. And that makes it significantly easier to pick something that that meets your needs. The important part here is to notice we found that the optimal results are quite often riskier than one would expect. And that again tells us that the personal risk tolerance really is a crucial parameter. So there is a component in choosing a portfolio that is not driven by math, but by your own behavior. And now I talked about the personal risk tolerance, but what is that? And many people understand this to be the maximum drawdown. And well, that's easy to calculate, so that's a plus. But it's surprisingly hard to imagine. And I talked to many people who told me, oh yeah, I'm fine with with losing up to 30%, but then after they lost 15, they think differently. So it seems much harder to imagine what the losses are than actually really experiencing them. And the other part that's really wrong with the maximal drawdown is there are no guarantees. So it's the maximum drawdown so far, but we have no idea what the probability of this is, where on the tails, how far out on the tails this drawdown that we've seen from our backtest or the historical data has been. And so therefore it is really hard to quantify that, to create a confidence interval around that. So therefore, we really need a better risk measure that is rooted in probabilities, in statistics. So basically another beast based on Monte Carlo simulations. And we've created that, but that is another presentation on its own, I guess, to explain how we did that. the main takeaway here really is the maximum drawdown is not something that you should rely on. Now this gets us almost to the end. So this is the quick summary. So we've created some Monte Carlo charts, and the real benefit here is we can now have clear answers to otherwise difficult or even impossible to answer questions. And we're able to remove all ambiguity and intuition from these answers. And there are some pitfalls. So these charts ignore the personal needs. So it's still important to think about your lifestyle, and it's still really important to think about your personal risk tolerance. And we assume that the returns, the distribution of returns is invariant over time. And well, for the stock market, if we look at data over 15 years or 20 years, they actually didn't change that much. If you look at 50 years, it doesn't make that much of a difference. When you look at Bitcoin, 3 years versus 6 years, it makes a huge difference. So it depends a little bit on the asset class that you're looking at, how that behaves and how much data we had, if we even understood what the cycles are. So there are some pitfalls to that. So it's easy to create charts that look pretty but are meaningless. But when we're looking at reasonably long periods of the standard assets, stocks and bonds, I think we should be fine. So that's it. So thanks a lot. And I guess I'm happy to answer any questions that you might have.
I love it. Yeah, this is great. Thanks, Felix, for taking the time of running through this. So yeah, I mean, I really enjoy this on so many levels. I mean, I feel like, wouldn't it be great if we, especially as systematic rules-based traders, would only show equity curves in these confidence intervals, right? To show like, here's your 95th percentile after 5 years, here's what you can expect, good, pessimistic, or optimistic, right? And having those bands, I feel like would just be such a more realistic, semi-comforting, semi-terrifying, depending on which side of the fence you're on, way to like visualize portfolios. So I think it's really cool what you've built here. And so the question is, you built this mostly, I think you alluded to, for members on Turing Trader trying to select the appropriate portfolio. This was to help them into one of those portfolios. What about for your personal creation phase, right? So when you're thinking about putting meta portfolios together, things like that, is this something you're using? Do you think about this in your own work on the way you build systems, implement?
Yes, absolutely. So the important part here is we created this for the portfolio wizard, but I'm using it pretty much every day when I'm analyzing portfolios. So Turing Trader is actually two parts. So turingtrader.com, that's the commercial membership site, but there's also turingtrader.org, which is the open source project with our backtesting engine. And so the backtesting engine that I'm using for development, that we're using for everything that is on turingtrader.com, is open source, and these Monte Carlo simulations are a feature of that backtesting engine. So whatever you simulate and build with Turing Trader, you get these Monte Carlo charts, and it is very, very helpful during strategy development as well to see whether your strategy actually has any positive effect or not.
Got it. Yep, that makes sense. And then I think you alluded to it too, like, can we think about optimizing on, or not optimizing necessarily, but seeing the pessimistic and optimistic, say, I don't know, risk of ruin or average drawdown, median drawdown? Can we look at, can we extrapolate that to those types of figures, as, especially as system builders, and look at those types of percentile distributions?
Yes. So if you look on turingtrader.com, there's actually a lot of these charts. Every portfolio comes with these Monte Carlo charts, and there is actually a curve there that shows a hypothetical drawdown and how the strategy would recover from it. The process of creating these is a little convoluted, where basically first we create a swarm of possible outcomes, then we rank the swarm by the maximum drawdown that they had, and from those we pick the 5th percentile, and then we look at how these developed over time, and that gives us basically an idea of how the strategy recovers from drawdowns. So it is close to the figures that are created by that are close to what happened in the 2008 recession, but not identical, and are hypothetical results but have statistical properties with them.
Got it.
So that gives you an idea of what the strategy might do, and is especially helpful when you want to compare two strategies and get an idea of how risky they are. And it's also especially helpful when you have strategies that work well most of the time and then create massive drawdowns in just a very short amount of time. So it's something that, for example, you see when you're selling naked puts.
Yeah.
That is something where your backtest might look perfect, but
right.
you most likely see that in the Monte Carlo simulations, the story is very different.
Yeah, that's interesting. I mean, I think my last question, thinking about especially the audience here, the folks that are going to tune in, we get a lot of traders that are probably not fully rules based, a lot of semi rules based or semi-automatic kind of traders where they're very structured, but they're still taking some discretion. How does one best apply these principles to maybe a process that has some discretion in it? I guess it's ultimately creating that swarm of outcomes is what they need to manufacture, right? To look at some past results and try and recreate their potential looking forward.
But I'm not necessarily sure how you do that when there's a discretionary element. So a discretionary element kind of tells me that the rules might also change over time, and today's rules might not be the same that I used a year ago. And so that makes it, I guess, very hard to create anything that is similar in kind.
Yeah. Got it. All right. Another checkbox in the old fully rules-based column, I think, for traders, and just the tools and the data that you have to make informed decisions. I think this is really powerful. So yeah, I think that's it in terms of questions. So Felix, thanks again for taking the time today. Anything else on your mind, folks? TuringTrader.com. That's the website there. Check out the portfolio. See if you got something that might help you invest in 2023 and beyond. And he's also got turingtrader.org. So again, if you are a programmer, coder, and you want to try your hand at automating some of this, getting a feel for the backtesting engine that Felix has created, I can attest it is what we use primarily here at TradeRisk now to build systems and to simulate Monte Carlo simulations just like this and everything else. And it's a very robust platform. So I would definitely recommend checking out turingtrader.org for those folks.
I actually have a comment on that. So we're working on a revamped engine. So if you look at the development branch on turingtrader.org, you will find that there's already a V2 engine in the development branch that is pretty much working. So we're going to release that at some point, hopefully in March. To be part of the master branch and the binary distribution. And what this new engine does is it focuses much more on calculating indices of strategies, which you can then later on map onto accounts. So basically what that means is that we do away with the idea of integer shares and everything is fractional and then at a later stage mapped onto your account and the integer quantities that you might need. And that creates a higher accuracy and not for the simulations, and you don't need to think about how much money you use to fund your strategy. Another thing that we have changed is that everything is now block-based instead of a streaming architecture. What that means in practical terms is that the engine is multi-threaded. So if you have a 16-core PC, for example, simulations can go significantly faster. So if you're interested in software development and familiar with Git and not afraid of compiling something from source, check out the development branch. I think this is really a step forward in making the engine both easier to use and faster and more powerful moving forward.
I love it. I've got system ideas in mind, and I just got a new rig with 12 cores, I think. So I'm ready. I'm ready for it. So I'm
Yes, you
excited.
sound like you are.
Yeah. I'm hungry. So yeah, as soon as I see that go active, I'm excited to get my hands on it. But yeah, folks, turntrader.com, turntrader.org, and we will always have this posted publicly. So if you've got comments or questions, leave one below, and I'll try and get Felix's attention if he doesn't notice it on himself to respond and help you out if you got some questions. But Felix, thanks again for taking the time today, and really enjoyed this.
All right. Well, thank you so much for having me, Evan. Have a great day and talk to you soon.
All right. See you, everybody.
Thanks. Bye-bye.